And I love what you said. You're starting to catch on now. It doesn't make sense to own where you sleep because even if you have that home paid off, it is a liability. If you want to understand what's an asset and what's a liability, assets put money in your pocket, liabilities take money from your pocket.
Yes.
Welcome back to the Wealth Eazy Show, where we talk all things wealth, health, and real estate. Today, my guest is a Formula 2000 Series auto racing driver turned mortgage broker. Please welcome to the show, Michael Brooks. Mike, thanks for being here.
Hey, thanks, John. Yeah, welcome. Just glad to be here.
Amazing. Give our guests and listeners a 2-minute bio on yourself because you've had a pretty great career. You were a race car driver for quite a while, and then you got into the mortgage brokering. So tell our listeners, give us a bio on yourself.
Yeah, for sure. So back in my early years, when I was a teenager into my early 20s, I did do some Formula open wheel racing all across North America in Formula 1600, Formula 2000, and then some of the series further up on my way to Formula 1. So that was kind of my journey back then. I did have a contract to go to Formula 1, but then with some injuries that had happened and different stages of life, I just had to take a break for a while. And then when I took that break, it's difficult to get back in. And a lot of things have changed in the year or two that I was off. So I decided I need to make a change and moved on from there.
But I think, we're friends outside of the studio. We're also personal friends. And you told me you actually got a Formula 1 contract because I was in your office and I saw the contract. Like, what was it like signing an F1 contract?
Yeah, I mean, back then it was a brand new team in Canada based out of Ottawa. And they were putting a bid together to become the first Canadian Formula 1 team ever. And through some connections I had during my racing career, the owner of that team came to me and signed me as one of their initial 2 drivers. That was an exciting experience. It was a little overwhelming at the time. Obviously, had to go meet with a lot of big executives and sponsors and things like that, signing some pretty serious contracts. So yeah, that was an exciting time, a little nerve-wracking, but a very exciting time. So
what's it take to get to that level? Because, a lot of guys, I mean, I follow a lot of NASCAR. I grew up on NASCAR. My grandfather raced stocks, way back when the exhibition stadium had a track. And, I've been following stock cars for many years. And I know that there's a lot of these guys, they start off in go-karts, like at 4 years old. Jeff Gordon started racing when he was 4 years old in go-karts. Yeah. Tony Stewart, all these guys. At what age did you actually start racing, and how did you get into racing?
So it's a good question because my journey is a little bit different than most. You're right. Most racers start when they're really young. Even in other sports, hockey, basketball, they start when they're really young and they pursue it for their whole life. I didn't get into open wheel racing until I was about 17 or 18. And my father had been driving short track stock cars, the NASCAR type stuff, around Ontario for a while. I grew up with that. But I never liked the stock cars. I liked the open wheel stuff, the faster stuff, right? Mm-hmm. So when I was about 18, I saved up and bought myself my own go-kart and just started racing at the local tracks. Started winning right away. Wow. And got noticed. Got asked to go get my racing license back then, which was done at Shannonville Motorsport Speedway. I went to get my racing license and I came in with a bag full of cash and change that I had saved up to pay the deposit for the racing school. And I was sitting there with a bunch of older guys that all just stroked checks for thousands of dollars to do this racing school. And at the time, they laughed at me because the guy who was running the school said, you have to have a PhD in order to get to Formula 1. And he said, Papa has dough. And so when I put my big bag of cash down and change down on the table for my deposit, for the damage deposit, they all laughed at me. But it was after the school where a lot of the other guys, they lost their checks for the damage deposit. I got all mine back because I passed with my racing license, didn't have any damage on the cars, and went on from there. So then from my racing school and getting my license, I got noticed with a local Formula 1600 team, got to race with them for a few years, and it just kind of spiraled from there. As I got better and got noticed, you start to get some sponsors. I worked my way up from one series to the next. Went and did some high-end shifter kart racing in the States with some really big teams down there and got noticed even further for that. And it was just, again, a spiral of just relentlessly pursuing your passion, never giving up. It took a ton of work because I didn't have the money and I didn't have all the extra years of experience. So for me, I had to really push every day and stay passionate and just pursue it with relentless dedication. And that's how I got to where I ended up.
Amazing. A lot, because I know, I mean, a lot of these guys who are in the series, they did start racing at 4 and 5 years old. So they already had maybe 15 years on you. So what kind of training did you have to do? I mean, were you in school? Were you working at the time? Were you doing this part-time? Like what kind of training did you have to do to get to that level and to get noticed?
Yeah. So the racing itself was sort of part-time because I was in school. I was going to Georgian College and I was working full-time as well, trying to save up my own money. So the racing itself was part-time. And back then we didn't have all the fancy video games and simulators and everything else where you could do it kind of off track. I had to wait for my times on track and do my practices and sessions and things like that and just gain as much experience as I could on the track when I could. What I was told by a lot of the team owners was that I was blessed enough to have natural talent. You see that in some of the best drivers in the world, the Max Verstappens, the Lewis Hamiltons, right? There's one thing to put in the time, which you have to, and the training, but you need some natural ability as well. And I was very fortunate enough to have that natural ability. So my learning curve was a little bit less. But it did take a lot of effort. And I was training with a trainer in the gym. I had vision trainers, I had physical trainers, I had physiotherapists, and I was training every minute of every day I wasn't working.
Wow.
So it takes a lot of effort.
Well, I know that, people don't look at, say, NASCAR drivers or auto racing drivers as athletes, but they are actually one of the top athletes, better than any NBA or even a hockey player, because you're in a car for several hours. And sometimes, I mean, I know in stock cars, I mean, it could get well over to 100 and something degrees in that car, during the summertime, and they don't have the luxury of air conditioning. And they have these fire suits on, so it can get really hot. I know I've heard stories where NASCAR drivers are losing sometimes 8 to 10 pounds of water in like, a matter of 3 hours in this car. So you got to go through a lot of endurance, I know, to race. Hey everyone, it's John. I just wanted to thank you for being here, and I would ask that you please subscribe to the show by just clicking the subscribe button right here. I'd really appreciate it. It helps grow the show so we can get even more successful guests on the program to help you. If you're already subscribed, a huge thank you. When you subscribe, you're going to get access to the program before anybody else does. So if you would, just click subscribe right here. Thanks so much, and welcome back to the Wealth Eazy Show. What skills, what did you learn from the auto racing? Because then you got into becoming a mortgage broker. And how did that transition going from auto racing into a mortgage broker?
So that's a good question. I get that a lot because it's a very strange transition.
They're like very complete opposite
spectrum,
spectrums, right?
So why would I be dedicating myself to going full out into auto racing and then move into sort of a people person kind of desk job, kind of mortgage broker life? Honestly, in the transition out of auto racing, when that kind of happened, when life just happened and I had to move out of that part of my life, the mortgage brokering kind of came and just fell in my lap. I wasn't really looking for it. I'd never been in sales before. My family's always been entrepreneurs. So although I had some small jobs when I was younger, as an adult, I never worked for anybody else. I either worked for myself or for my family businesses. My brother is a realtor, owns his own brokerage. My father owns a sign business he's owned for his whole life. I managed that for a while I was racing. So I had the entrepreneurial spirit being brought up, and I wanted to do something myself. I didn't, at the time, love the real estate that my brother was in, just due to the timing and things like that. I thought, not so much for me. But I liked working with people, and I had a passion to help people. So I got connected with Dwight Trafford, our boss, Heard him on the radio and set up a meeting with him, and just met with him and Laura back almost 15 years ago now at our house over coffee. He explained the business to me, and I don't know, something just clicked. It was like, yeah, you know what? I think this sounds like something I could do. Mm-hmm. And that's kind of my journey getting into mortgage brokering. And then I've just grown and learned over the years and had a real passion for it now.
Yes. My story about getting into the mortgage business is not far off of yours. I mean, I've been in the wealth management business for 25 years. And I knew Dwight because I was a member at the same golf and country club, and sometimes we would play together. And I knew he was in the mortgage business. And so when I sold a home in Caledon, and I bought one in Woodbridge, and I got Dwight to do the mortgage. And I said to him, how do I get paid on this? Like, I want to get paid. Like, how do I get something out of this? He said, well, go get licensed. I said, how do you do that? He says, I'll send you a link. So at that time, I had a home in Sarasota, Florida. I used to spend my winters down there. And literally, I took the month of January, sat by my pool, smoked cigars every day, read the book, flew home, got my license, and I took over the mortgage, and I got paid. I'm like, this is like the easiest money I've ever made. I'm like, I think I can combine the two because you know, the mortgage business, wealth management business, they're symbiotic.
Yep.
And then I got into real estate again. All of these businesses, they're all symbiotic. And I just started learning from Dwight the mortgage business and started learning the products. And I'm like, this is like really easy money if you understand the business, because I already had a massive network of clients. So just adding something into my repertoire was not difficult. It's just now letting my network know.
Yeah.
So you've been in a family of entrepreneurs. What did you learn from your dad and from your brother in running a business? What tools did you learn from them that made you a successful mortgage broker?
So you'll know, because you're an entrepreneur in many different areas: financial planning, mortgage brokering, real estate. So you know, I think the employed general public has a misconception of entrepreneur. They look at us and they say, oh, it's so nice to have your own business, all the perks, you know, you guys got it made. And then the governments, of course, they're like, well, that's not fair. Tax, right? They always say it's not fair to live the life we're living. What I learned, though, is, yeah, it comes with perks, obviously. That's why you run your own business. But it's a crap load of work. And just never give up. Always pursue excellence. Passionately pursue everything. And just make sure you put people first. And when you're putting others first above yourself, genuinely, people can see that. They're drawn to you, and that's what helps grow your business. I think that's kind of what I learned from my dad over the years, is just, you know, never give up. There will be ups and downs. Push through and put people first.
And sometimes failures.
Yeah, but learn from failures, right?
Yeah.
Some people take failures and then it just crushes them. But an entrepreneur looks at failures as a means of learning and growing and getting more successful. Like if we're not failing, we're not going anywhere, right? Yeah. You can't be afraid to fail as an entrepreneur. Otherwise, don't do it.
No, exactly. And the way I look at failure is just one way of not doing it correctly. There's got to be another way of doing it correctly, right?
Exactly.
You know, it's funny. People, yeah, you're right. People look at entrepreneurs and go, "Oh, nice life you got there." I go, it's almost like being pregnant. You know, everyone says, "Congratulations, you're pregnant," but no one knows how many times you got fucked.
There you
right?
go.
In business, you get fucked a lot.
Yeah.
But it's what you said. You got to push through the negativity, and it is a lot of risk. It's a massive. It's a leap of faith, you know, to go from a salary job, trading time for money. I call it trading time for money.
Yeah.
Okay. And going out on your own and saying, I'm no longer going to trade time for money. I'm going to trade time for equity. I'm going to trade time. I'm going to build equity into my business. And that's where the real 100%. Money is made. Yeah. And a lot of people, they don't have it in them. They're too afraid to take that leap. And they would just rather have that security. And that's okay. I was never one to work for someone.
Yeah.
I just can't. I need to go out on my own, and I don't want to have someone dictate to me what I am worth. So you know, you've won a bunch of awards. You picked up the mortgage brokering quite easily, and you won, you know, Rookie of the Year. What do you think sets your level of service apart from others?
So in our industry, in real estate and financial planning and mortgage brokering, everybody can just blanketly say, I offer better service, right? What's that look like? What's that mean? Well, I mean, I can talk to my clients nicer. I can make sure I get them the best rates, you know, all those types of little things. But what I feel sets me apart is that I look at people as more than just a transaction, and I try and look at the big picture for their life. My slogan is moving you forward. So I try and find strategies, tools, and techniques to not just simply get them a cheap rate. They can go to a bank for that. It's about getting them the best product, rate, and tool and strategy to get them from where they are now to where they need to be or want to be in the future, financially free, wealthier. Like I heard one of your guests talk about, Richard Dolan, multi-generational wealth, kind of helping them move into that next stage of life and not stay trapped in the cycle that the banks and the government want to keep them in, right? So that's, I think, what sets me apart.
Well, I think also with too, because I actually know you on a personal level too, and I see a lot of your videos and your social media, is that you're not just a transactional broker. You actually hold their hand and you walk side by side with them, which a lot of brokers don't do. I mean, anybody could be a transactional broker, right? Again, you can go to a bank for a good rate, but it's not always about rate. I find in this business, it's actually about product and having knowledge of the product and then finding what actually fits for what the client is looking for.
Yeah, 100%.
Right. So I personally know with you that you actually get emotionally involved with your clients because you do want to see them succeed. And do you think the way you run your mortgage business comes from the hard-nosed training that you actually had throughout auto racing? Because you got to be very disciplined in the auto racing. Do you think that what you learned in there is helping you today to run your mortgage business?
100%, because the training I had to do when I was racing, again, was every day, put everything into it 100%, because there was a target, there was a goal. I had to achieve that. And if I slacked off, if I gave up early, I wasn't going to achieve that. When it comes to mortgages and helping clients, our first job is to provide a solution for the client's problem. Nobody wants a mortgage, right? I don't want to go hundreds of thousands in debt. They want a solution to their problem. And to do that effectively, you need to be a good negotiator with the banks, with your underwriters, things like that. And you have to know when and where to push, how to negotiate, and how to get what you need for that client's situation. And you have to be able to not give up when you hit a roadblock. And some people do, like some brokers, they'll get declined at a bank and they'll just say, sorry, I can't get you a mortgage. But not with us, not with me, right? We push, we find solutions, we strategize, we get creative with financing, and we find ways to help them. Obviously, there's certain situations you can't. You have to just admit that as part of the job. But whenever there is a solution to be found, we will find it.
Well, I know from me being in the business for now, 12 years, I guess, that we have access as a broker. We have access to a lot of different lenders, and A lenders, B lenders, privates. Yeah. So if a client can't get a deal done with an A lender, you're right. Some brokers will just say, I'm sorry, I can't help you. Where an experienced person like yourself is going to, okay, we can't get it done through an A lender. Let's take it to a B lender because they have a little bit more wiggle room. They might be able to extend their ratios to get this deal done. You know, as a mortgage broker, what do you think are the most common misconceptions or myths that you encounter with clients when it comes to getting a mortgage?
So one obviously is that we always charge fees. I get that a lot.
Yeah.
Right? Which is totally untrue. Mortgage brokers, first off, do not charge fees unless it's on a B mortgage or a private or something like that. But if it's a cookie cutter A type mortgage, brokers don't charge fees. Banks will tell them that because they want to keep the business and they want to instill fear. But brokers in general do not charge fees. So that's one misconception. And then the other is that we only deal with people with bad credit. We don't help regular folks that have great credit, good incomes, things like that they should just go to the bank, which is untrue. Things like going to a broker is going to hurt your credit. So those types of things are questions that might come up, but we have answers for all those, obviously.
Yes. And by the way, for the people listening, we do get paid. We don't do this pro bono. The banks pay us.
Yes, that's right.
Right? The banks pay us a fee. Therefore, we're not charging directly to the client unless you're right, if it's a private deal or if it's a B lender, because B lenders, they don't pay.
Yeah.
So we do have to get paid. We have families to feed. But if we're getting you an A lender, we get paid by the lender.
Yeah. And you'll know because you're in the business. I had this actually just come up as a comment on one of my TikToks recently.
Okay.
Somebody said, I'm full of crap. Don't go to a broker because even though the bank pays me a commission, they're building that in on the back end and they're going to charge you higher rates through the broker and worse mortgage products through the broker. I obviously had to correct that and say, just to clarify, brokers as a whole, as an industry, give so much volume to the banks that we often get better rates than the banks will get.
Yes, we do.
Clients have come to me with a bank pre-approval and I've beaten it with the same bank. There's no extra fees. We don't hurt their credit. We actually help their credit. And there's just more benefits. I say, if it's the biggest financial purchase in your life, what would you do if you had a heart attack or some kind of cancer? Would you just go and trust one person's advice, or would you get second opinion, third opinion, fourth opinion, and make sure you're getting the best advice from the best surgeon to take the best care of you? It's a very important decision.
Absolutely.
Right? So when you're going to get the biggest financial burden in your life, your mortgage, why would you go to your own bank who is biased and can only provide you their own products? Do you think if you walk into TD, they're going to say, oh, by the way, Mr. John, RBC has a better deal down the road. Just go down there.
I'm not going to tell you that.
Yeah, exactly.
They want the business.
Why wouldn't you come to an unbiased professional who spends their life dedicated to learning and growing and being educated in the mortgage industry, who can shop all the lenders in the market and provide you the best solution to your problem? In most cases at no fee.
And that's a really good point, because a lot of people think, well, I do business with them and, I've got a few my investment account is over at TD or RBC or whatever lender or banker you're dealing with. So they're going to give me a really good rate. Wrong. Because you're walking in there by yourself and you're looking for $500, $600, $700, $1 million mortgage.
Yeah.
Okay. We're putting through hundreds of millions of dollars. Who do you think's getting the better rate? Yeah. You by yourself or the broker who's putting in hundreds of millions? Not just us itself, but as a brokerage itself, right? Because we get to cumulatively combine all of our deals together with any lender, and we get volume discounts. So we're going to get you, you're right, we deal with many lenders, like 30, 35 different lenders. So you're right. You're going to get 35 different opinions, or you can get one, which is, I think it's just idiocracy that what people actually think, or they heard some guy on TikTok giving them this bad advice. It's ridiculous.
Yeah.
Why do you feel the general population is so focused on rate rather than the right product for them?
Well, I feel it's because there's been so much attention, media, advertising, education around saving money. That's the middle class mentality, right? There's not enough to go around. Inflation is rising, cost of living is rising, everything else. So I need to save. So where can I save? Well, maybe I can save on my interest rate, right? It's that middle class mentality that the banks and the government want to keep them in, because if they keep them in that middle class, they all make more money, not the middle class, right? The government's taxing the middle class more. They say they're taxing the wealthy, but all funnels down to the middle class. The banks make billions off the middle class. And people just, I shouldn't say aren't, because now they're starting to wake up. You'll see that in your insurance and everything else. People are starting to clue in because guys like you and I are educating them. They're starting to clue in that there's a big difference between the interest rate, which is the piece of paper that says maybe 4% on it, versus the total cost of borrowing over the life of that mortgage. If I get a 4% interest rate and it takes me 25 or 30 years to pay it off, the banks are making hundreds of thousands of dollars in interest over and above the principal I borrowed. If I get that same mortgage at 7.5%, but I can pay it off in 10 years, my cost of borrowing is cut in half or better. So there's a big difference. And rate doesn't necessarily mean you're saving money.
Well, that's the other thing too. And a lot of people say, well, I want a low payment, so I'm going to take a 30-year amortization. Well, yes, you can have a lower payment, but it just means that you're going to feed the bank more interest over that period of time.
Yeah.
Because you're extending it by another 5 years. And what people don't understand is the mortgage interest is calculated upfront.
Yeah.
How many clients do you meet with that say, I want to be able to double up my mortgage payments, or I want to know how much can I prepay each year? Yeah. I'm like, why is that important? I just met with a client last week, and we're going to do some insurance. And he gave me a number that he was comfortable with doing each month. And I started getting to stuff about his mortgage. And he says, yeah, I'm making an extra $1,000 a month into my mortgage payment. I said, wait. Why are you doing this? Well, I want to reduce I want to pay off my mortgage faster. I said, do you think you're going to save interest? Yes. Not really, because the mortgage interest is calculated up front. And when you make this extra mortgage payment each month, do you see the next month payment decrease? No. Not even until the term is over do you see any difference. All the bank is doing is they're taking your money, they're hanging on to it, and then a separate account for you, and then they're putting that money to work. So while you are now impoverished, you've given up the access, use, and control of that money. Yeah. The bank is actually putting it to work. You're not doing anything to your mortgage because it's not going into the principal. Your amortization is already set, and you're paying this interest regardless. So I said, you're not really getting ahead where we can actually take that extra $1,000 a month, and we can add that to funding a life insurance policy where you will get access, control, and use of that money at any point in time. Yeah. Explain the difference between APR and ACF, because you kind of just touched on it, but a lot of people, they see on the mortgage commitment APR, but APR and ACF are the cost of funds is very different. Explain that for my listeners.
Yeah. So just touching on what we talked about a second ago, APR is the interest rate that you're paying on the borrowing of that money. So if the bank gives you a $500,000 loan at 4.5%, the 4.5 is basically your APR. There's a few things that can go into that, but APR is essentially the rate. ACF, they never tell you. It's not even a number. They don't even know what that means. Nobody publishes that. They don't talk about it. It means nothing to the banks. But that stands for actual cost of funds. Mm-hmm. And again, going back to that example, a $500,000 mortgage at, let's say, 4.5%, let's say over 30 years, that's probably going to cost you close to double. It's going to have about $500,000 of interest on it.
Oh, yeah.
So it's going to cost you $1 million to borrow $500,000. And the problem is most people trapped in the cycle of mortgages, as you know, because we refinance a lot of people, they'll go into a 30-year mortgage. 5 years later, they'll come and roll in a bunch of debt and go back to a 30-year mortgage. 5 years later, they'll come back, they're rolling a bunch of debt and go back to a 30-year mortgage. They're always resetting that clock back to 30 years.
Yeah.
And the initial 10, 15, 20 years of that mortgage is all interest, right?
Yeah.
They're not accelerating the payment off. So they're going to forever be paying off a mortgage.
Yeah.
So they don't realize that the total cost of borrowing is massive, despite the fact they mentally feel they have a small interest rate and they're paying a monthly payment that's small and they're like, yay. But
yeah, and that's a really great point that you bring up, and just I want to elaborate a little bit on it. I just did a mortgage for a client, buying a $2 million home, put 20% down. He's got a mortgage of 1.6 with a 30-year amortization, and today's fixed rate at 5.6. His his monthly mortgage payment is $9,100. Okay, guess how much of that is interest? $7,400.
Yeah.
So he's got a 5.6. Folks, I want you to listen to this. His APR is 5.6%. But do you know what his cost of funds is? It's like 80%.
Yeah.
Because of that $9,100 mortgage, only $7,300. Well, not only 73 is interest, only about 1,700 is going to the actual principal. So he's putting out $9,100 a month, 7,300, almost, it's close to $7,400 is going to the bank of interest. His cost of borrowing is 80%. Do the math.
Right? Yeah. It's ridiculous.
That's insane.
Yeah. And people don't realize too, which is why we eventually educate them on these products. A mortgage. So everybody always says, I'm going to get a mortgage, pay it off, and then I'm mortgage free and I'm set. That's their mentality, right? That's the old school mentality from generations past that our parents taught us, buy a house, pay off the mortgage, and you're good to go. Now you own the house, right? It's an asset. Well, we know a house is never an asset because there's always liabilities attached to it. The heat, the maintenance, the utilities.
Principal residence.
Principal residence.
Principal residence.
Yeah, clarify. Principal residence
is always a liability.
Exactly.
Even if it's paid off.
Yeah, so they say they're going to pay it off and then they're all set. But what's the problem with putting equity into a principal residence over time by paying off your mortgage? All the time during those years, you're putting money in. It's locked. You don't get it back out. I can't make a payment on my mortgage and I tell the bank I want that money back, right? So You're always locked. It's a one-way street. And then once it's paid off, it's locked. What are you going to do with it? Okay, well, you can sell it, maybe, right? That's the only way you can get the money out, or put another mortgage on it, right?
Or get a HELOC
again, right? Or HELOC.
But yeah, you got to qualify. So you're asking the bank again permission to borrow your money out, and you have to qualify.
Yeah. So they don't realize that it's a one-way street for all those years, but with the right tools and products, it can be a two-way street. And sure, an owner-occupied house is maybe not the best investment because it's a liability. Buying investment properties is a much better way to go. But if you own an owner-occupied house, there's tools and strategies that you can use that make way better use of that equity during the term. So you can access every dollar you put into that house the whole time you have that HELOC on there. And then you can be using that to double leverage, triple leverage, and pull out and invest in other products like your life insurance or other investments. Yeah,
so let's jump right into that, because I watched a video where the guy was saying it's actually better to have your full mortgage set up as a HELOC. Mm-hmm. Okay, explain, because I know you're doing a lot of this.
Yeah.
Explain why that is good, because there's a lot of financial gurus out there, and they'll say, make extra payments onto your mortgage and you'll be debt free. You'll pay it off faster. Bullshit. You're not going to pay. You're reducing the amortization, but you're still going to pay all that interest up front because the bank is charging it up front and they want all of their interest. Okay. So you're really not paying it off fast. You just shorten the amortization, but you've given up, like you said, you've given up access, control, and use of the money. Even those extra payments that you could have put aside for a future use or into an investment, that's not the way to do things. But if you set your home up as a HELOC, which I know that you have a product that I know you want to talk about, and it actually really reduces, you can actually pay off your home in 7 years or 10 years.
7 to 10 years.
Explain how you do this, because this really is how you actually should set your mortgage up.
Yeah. And the strategy first starts with a HELOC, because a HELOC is a two-way street. Every time I put $1 into my mortgage, I can pull it right back out right away.
And for people listening, a HELOC is a home equity line of credit.
Correct. So think of it as a line of credit. The bank is a credit card, basically, right? Usually with a bigger limit. A home equity line of credit is the same thing, but it's much bigger and it's secured against your house like a mortgage is. That's the collateral. So they can give you a lower interest rate and a larger amount. So that's what a HELOC is. But a HELOC is a two-way street. So if I put $1,000 into my mortgage as a prepayment, I lost $1,000 in income, and I have no access to that money to go and invest. It's just stuck in my house. It's a one-way street. If I put it into my HELOC, I've paid my HELOC down by $1,000, which reduces the interest cost to me on the HELOC. So my interest payment is less for that month. But now right away, I can pull that money back out and then go and invest it into something that's going to generate passive income.
Is this because the mortgage interest is calculated upfront and amortized over 20, 40, 25, or 30 years, but a HELOC is actually simple interest?
Correct. So the interest calculation on a mortgage and a HELOC are much different. Mm-hmm. And then if you want to break that down even further, a traditional HELOC with Scotia, TD, BMO, one of the big banks, their simple interest compounded monthly. So the interest payment for June 1st would be based on the balance owing at the end of May. So the previous month's balance is what the interest payment is going to be calculated on. There's another tool that's in the market that's been around for a long time, but it's never been utilized properly. I'll say because of lack of education, brokers don't understand it. They don't teach it properly because there's a whole strategy behind how to use it properly. Mm-hmm. But there's a special HELOC that functions more like a bank account on your house. And it has daily average interest. Now, when I talk to people and they don't understand it yet, they say, ooh, daily interest, that's going to cost me way more because they're charging me interest every day. Except the strategy is to keep the balance in the HELOC as low as possible for as many days as possible during the month. And because it takes the average balance over the 30 days of the month, that's what the payment's based on. You can lower the minimum payment, the interest payment on the HELOC quite a bit versus a traditional HELOC that's only based month to month.
Now, how does somebody do that? How does somebody keep their HELOC balance as low as possible each day?
So this strategy only works for clients that have an income to expense buffer of about 20-25%. So I'm making $10,000, but I'm only spending $7,500 a month, and I have that buffer. For the clients that don't have that, we offer education and budget consultations to help them fix their budget. But when you get to that level where you have a buffer, the premise is because this specific HELOC functions like a bank account, it actually is a bank account. Like you get online access to it. You can do e-transfers from it. You get a debit card with it. You get access to bank machines. You can deposit into it. It's a full-fledged bank account. It's just registered against your house. So because of that fact, to stimulate and accelerate the payoff, we encourage you to use this new bank account as your main daily banking. So if I currently bank with RBC, once you get this new one, you're going to transfer all your banking from RBC over to the new product, which is with Manulife, and you're going to deposit your income into this new account, and you're going to pay out your expenses from the account, just like you normally would. So that's the very first strategy to help accelerate it, is use it as your daily banking. And so as your income goes in at the beginning of the month, that decreases the balance owing on day one. And then we teach people how to pay their expenses through different means, through credit cards and other things, to keep that balance as low as possible and not pay out too many expenses from it during the month. And then at the end of the month, just pay off the credit card, which increases the balance again by that amount of expenses. But the daily average balance has been kept so low for the 30 days, the actual interest payment calculated is much cheaper, hundreds cheaper than it would be on a similar separate HELOC.
This is a fantastic strategy, and I'll tell you why. Because I know this product. I know what you're saying, but I'm going to break it down in really simplistic terms for my listeners. You go to Manulife and you get, it's called the Manu1 product.
Manulife One.
Manulife
Correct.
One. And whatever amount of mortgage, and I believe by law, you can only up to 65%, right?
Yep.
So you can have sub accounts. So you can actually have, if you need a $500,000 mortgage, 65%, it can be set up as a HELOC, and then you can have sub accounts, which are actual fixed rates, and you actually make payments on them.
Yep.
But your main account is actually, your HELOC is actually going to be your bank account too.
Yeah.
So all of your paychecks are going to go into this account. So you're going to get a line of credit for 65% of the $500,000 mortgage that you need. All of your checks are going to go in, which is actually reducing the balance. And you say that it's calculated daily.
Yep.
So now the interest at the end of the month, you're going to keep it low. So you're right. I think it's a fantastic idea to start using credit cards to go buy your groceries, make your car payments, do everything, and then you reconcile it at the end of the month. So over time, you will pay less interest. Now, how does that work out to paying off your mortgage in like 7 or 10 years?
The way it functions is by that buffer of 20 to 25% income to expense ratio. Because it's your main bank account, all your income's going in, expenses coming out. Every month, you're not only making the interest payment, but you're accelerating it by that buffer of income to expenses. So it's like an accelerated pay down because that money stays in the account, right? So every month I pay the interest payment plus the extra from my income that is the buffer. And so in a traditional example, you can take a 4.5% mortgage over 30 years, take a 7.5% Manulife One, and pay that same amount off in 7 to 10 years.
Well, because the interest is calculated much differently.
Exactly.
Right. But Mike, are you not finding in today's economic environment that people are living hand to mouth, like paycheck to paycheck, and people are spending, $1.60 or was it almost $1.80 now for every dollar they earn? Like, what are you seeing out there with clients? Like, do people actually have money left over at the end of the month?
So there are some people that just do right now, which we've put into Manulife Ones right off the bat and help them to accelerate where they're at. There's others, you're right, they're not at that spot. And they live in that mentality of overspending or barely making it by or living paycheck to paycheck or putting things on credit card because they can't afford it with the cash they're earning, right? Those people, we're helping educate them, do budget seminars with them, realize where there's leaks, where they're overspending that they don't need to. And we kind of help them reconcile their budget down to a more manageable level to help them to live within their means. But then you can't just stop there because that gets back into the middle class mentality of just, I got to save everywhere I can because I don't have enough income, right? So we got to figure out what they have right now, fix it, and get it within good working parameters. But then we have to provide them strategies to build other streams of income because the next step is more income, right? There's so much money in the world. There's no shortage of money. It's just that we have to help them find it.
Yeah.
Right? And they have to want it. It's not a greedy pursuit of money. It's recognizing that there is no shortage of money. Don't live in that mindset that I don't have enough to live on. Just look for all of the ways and the strategies there are to go and get more of the money that's out there.
Well, I think the way a lot of people view money is poor people view money as a means to pay bills.
Yep.
Middle-class people view money as a means to pay liabilities. And what I mean by that is buying cars to impress people that they don't know.
Buy stuff.
They buy consumerism.
Yes.
They buy stuff and they're constantly paying off they'll rack up their credit card, they pay it off. They rack it up, they pay it off. They're never getting ahead.
Yep.
where wealthy people view money as a means to buy assets that produce cash flow
Yes.
that pay their liabilities.
Exactly.
What financial principles are you using? Because I use the financial principle of live 50, 30, 20.
Yeah.
I have it here. This is my moniker. This is my formula to success is you use 50% of your income for your needs,
Yep.
your fixed expenses. You use 30% of your income for your debt and for your lifestyle, your wants. And 20% is gone to savings and investment, but you have to use it in the reverse. You pay yourself first to 20% because if you're always trying to, do it the other way around, most people, they end up spending 100% of what they make and they're never getting ahead.
Yep.
You got to pay yourself first. Warren Buffett said it.
Yep.
If you pay yourself first, you'll never go broke. Pay yourself that 20%. Learn to live on 80%. If you can't live on 80%, like you said, you help people find those financial leaks, as do I. One of my biggest thing that I pride myself on is let's take a look at what you're currently doing. Let's plug the financial leaks, and I guarantee you, if we can strip out some of that lifestyle, those wants, you'll have the money to save. We'll find the money. What financial principles are you using with your clients to achieve financial success?
So I love the 50, 30, 20. I've always grown up with simplified 80, 20. I love how you've broken it down 50, 30, 20. But the 80, 20 rule is something that we've always lived by in our house, right? So live on 80% of your income and give and invest the rest. Mm-hmm. So that's just something we've grown up with, and I try and teach that same strategy to other people. So that's the number one principle to get your spending under control. And then another one that I've come across in the last little while as I've grown, and I like, is don't use earned income that you trade time for money to buy stuff, to buy vacations and cars and watches and toys and TVs. And don't do that, right? Use passive income to pay for those types of things, your lifestyle. Earned income should all go towards, some towards paying bills and liabilities, but the rest should all go towards investing in passive income generating tools like life insurance policies, like multifamily real estate portfolios, things like that can generate passive income. Don't use your earned income to buy stuff. That's where people go wrong. That's the consumerism, right? Ooh, I want a new car. I just worked hard. I got a bonus. I'm going to go buy this new car. I want a new TV, Okay, so I just worked. I got a paycheck. I'll go and buy a TV, or I'll put on the credit card. They buy stuff with their hard-earned money from trading time for money. And that's one thing I've learned in the last little while. Stop doing that. Use passive income.
Well, that's the middle class mentality.
Yep.
And the wealthy, Robert Kiyosaki said it in Rich Dad, Poor Dad.
Yep.
Wealthy people use their earned income to buy assets that produce passive income. Just as you said, that's what the wealthy people do.
Yep.
Let's get back to some mortgages, because the federal government in this recent budget actually just made a slight change to first-time home buyers and insured. What do you think about the new rule change, and how do you think it's going to affect the real estate market, where first-time home buyers can buy an insured mortgage? An insured mortgage is any home that is less than $1 million.
Yep.
They don't have to have the 20%. They could put 5%. They could put 10%. So the bank will get this insured, but the client has to pay for it. Mm-hmm. But you had to do a 25-year amortization. Yeah. Now the government is saying, well, we want to incentivize home ownership. So we're going to make it a 30-year amortization.
I see you smiling because you know my answer.
I think this is smoke and mirrors.
Honestly, I was gonna say this is just a tactic to buy votes. It's a meaningless effort to try and impact a very large scale problem. It's meaningless because they've only allowed it to be on first-time home buyers' insured mortgages on brand new constructed homes. First off, most people that buy into new construction are putting deposits down during the 2 or 3 years of construction, and they end up having 20% anyways. That's a non-insured mortgage, so it doesn't affect them. If you do put less than 20% down on a new insured home, a lot of times they're over $1 million. So again, it doesn't affect you. The people that it will affect is such a small minority that it's basically just they're throwing numbers out there to make it seem like they're doing something to generate votes for the upcoming election. It's not really going to impact the market in any meaningful way.
Well, here's the thing. We have a finance minister who doesn't have a finance degree, who at the age of 40, her and her husband actually had to get her parents to co-sign for a $1.4 million mortgage. So what you're saying is, so over the last 40 years, and you've earned some good money, that you didn't save enough money to get qualified and you are a finance minister? This is a complete clown show. Yep. We have a leader, our prime minister, who on TV, on camera says, I don't think about monetary policy. Well, clearly your budget shows that.
Yes.
Again, it's like what you're saying. These two clowns are out there trying to buy votes because they're losing so badly in the polls, and they're trying to win over the middle class and the people that can't afford to buy homes. Let you in on a little bit secret, Mr. Trudeau. People can't buy homes because they don't have the fucking money. The down payment is too much. They don't have the income to even qualify. It has nothing to do with extending amortization 5 years.
Yep.
They've got to save a couple $100,000 or $100,000 to put down, and then they don't have the income because the wages haven't risen with inflation over the last 20 years.
Yeah.
They can't even qualify.
Yep.
And then they come out with this whole renter's bill of rights. Well, you know what? We want landlords to start recording their rental payments and build a credit check. I don't know how many people that you have seen that got turned down from a mortgage because of bad credit. They got turned down because their ratios were out of line, or they needed a couple $100,000
Yep.
as a down payment.
Yep. And so I heard you touch on it in one of your other podcasts. Good point there. The government's trying to fix, in their mind, the housing crisis by getting more people into home ownership. But again, that's old school mentality. And even I fell into that. We have a house, but we're learning and changing things as we grow. And we're realizing owning an owner-occupied home should not be your goal. If you are looking to get into real estate and own a home, it should be an investment property right off the bat. Stay renting. I know you rent, right?
I do.
So renting where you live and owning where you generate income is much better, right? So when we get
you learn from Grant Cardone.
Exactly, right?
I learned from Grant Cardone.
Right? Look, so we're teaching people now that are coming and looking to buy homes. First off, look for a place that you can live and rent. So maybe a duplex, triplex, quadplex, right? So they can rent all the other units and live in it. So they have a place to live, but it's being paid for, cash flow. Now, the second problem is, okay, well, I don't have a down payment of 20% because that's what you need for an investment property. But if you're living in one of the units, guess what? You can buy it with 5% down. That's one option. People don't realize that. So now they have a rental property, they're living in one of the units, and they bought it with 5% down, insured mortgage, right? Second option, though, is that we now have partners in the industry who can offer up to 20% down payment as a grant, shared equity program, and you can buy your owner-occupied rental with 20% down. So if I have 5%, I don't want to pay the CMHC fees, and it is my first home, okay, great. Go in and buy it. You got a duplex or triplex, rent the other 2 units, partake in the shared equity program through our partners. They'll give you the extra money to go 20% down, no CMHC fees. Now you've got an investment property, right?
Yep.
And then as you grow and you work your way out of that over the years, you can then finally pay off the shared equity program, rent the extra unit, and go and do it again.
Yep.
Right? And so we start to leverage their assets over time. But we start with a cash flowing asset. We don't start with a liability anymore.
That's correct. And you know when I learned this? I learned this going through my divorce. Because I owned a home since I was, 30 years old. And I went into a bunch of homes and went through my divorce, had to sell my home, and all the money from the sale of my home had to go into a trust account with her lawyer. And I was forced to rent. And I was like, I was just depressed. I'm like, oh my God, I'm renting again. What's my family going to think? What are people going to think? You know, there's a successful guy, he's renting. And then I started listening to Grant Cardone.
Yeah.
And he started to make sense. And here's a billionaire. I think he owns now in Florida, but for many years, he didn't own anything.
He actually just listed his owner-occupied house for sale.
There you go. Right? And so I'm not ashamed to say that I rent, because here's what I learned. The math makes sense.
Yep.
Okay. So I live in a $2 million home. It's probably like $2.2 million home. It's a fairly large home. It's very comfortable for us. But I pay rent of $4,000 a month. And people go, how do you pay rent of $4,000? Well, I've lived there for 3 years.
Yeah.
And because I've maintained the property and I've actually put a little bit of money into the yard and some gardening, the landlord loves me. And I never miss a payment. I'm on time. That check clears every month. So she hasn't increased my rent over the last couple of years.
Yep.
So I pay $4,000 a month to sleep.
Yep.
That's what a home is. It's there for sleep. People have 3 basic needs, right? Food, clothing, and shelter. When you go on vacation, do you rent a hotel room or do you buy a hotel?
Exactly.
We rent it, right? Because we're only there for a short period of time and we want flexibility.
Yeah.
So I rent where I sleep and I pay $4,000. Now let's take a look if I was to buy that. If I was to buy this property, let's assume on the low end, it's $2 million. I have to put down 20%, so I'm out of pocket $400,000. That's $400,000 that I no longer have access, control, and use of. Yep. It's gone into a home where you touched on it a little bit ago. It's locked up. I can't access that. It's called dead equity. Yep. It's equity jail.
Yep.
Okay? Doesn't earn me anything. So now I'm out $400,000. And I have to get a $1.6 million mortgage. And I just told you, I just did it for a client. My mortgage payment's $9,100. Then you have phantom costs, right? We have phantom costs. I've got a video coming out. I think it's going to be today or tomorrow. I shot a real quick reel in my car talking about this.
Yep.
Your phantom costs are your taxes, maintenance, and insurance. If I add up the taxes on my property, the maintenance on it, and the insurance, I'm $11,000 a month to sleep. I pay $4,000. That's 2.5 times more. So I actually have $7,000 a month extra that I could put toward an investment. I could put toward a future event.
Yep.
That $400,000 I could take and I can go buy 4 pre-construction properties. $100,000 I could put down on 4 pre-construction properties. Or I could buy a couple, or I could go buy an investment property. Mm-hmm. And guess what? I put a tenant in there. It's cash flowing. Yep. And with today's rates, if I'm a little short, guess what? I'm saving $7,000 where I live for a property that I'm having tenants there paying me up. And I know when interest rates come down, it will start to cash flow, but it's not costing me anything.
Yeah.
Yeah. So I believe in owning real estate.
Yes.
Own real estate. And I love what you said. You're starting to catch on now. It doesn't make sense to own where you sleep because even if you have that home paid off, it is a liability. And if you want to understand what's an asset and what's a liability, assets put money in your pocket. Liabilities take money from your pocket.
Yes.
And you just said it. If you have a duplex or a triplex or a quadplex where you're actually living there in one of the units and you have people paying you rent, now it's putting money. That becomes an asset.
Yeah. Do you want to hear a cool story? Because I was just at GrowthCon with Grant Cardone.
Yeah, and I want to talk about that because you just became a 10X mentor. So I'd like to hear about that.
Yeah. So I'll tell you a quick story from GrowthCon though that was very cool for me to hear. I got to meet Arnold Schwarzenegger.
Amazing.
Okay, Governor Schwarzenegger, like crazy personality. What an awesome guy to meet. And to hear his story blew my mind because we all think we know his story. He came over with nothing. He worked his way up to be Mr. Olympia, I think it was.
Several times,
or whatever.
Mr. Universe.
Mr. Universe, sorry.
Yeah.
And then he went into acting, and everybody thinks that was his journey, and that's how he became rich, and then he became the governor, etc. He told his story. He was a multimillionaire in America in real estate before he ever got into acting.
Wow.
He came over with nothing. He was staying with a buddy in an apartment, just scrounging away money as he worked out in the gyms every day. Every little bit he made from TV and whatever else he was in on and the Mr. Universe competitions, he just socked it away in cash. He had saved up, this is back in the 70s, he had saved up $27,000 in cash. And he found this little real estate lady and he said, I want to go buy a house. I want to go buy a house now. I've got some money. And big 6 foot something Arnold laughed and he said, this little Bulgarian lady this big told me, no, you're not buying a house. She says, you're going to buy this sixplex down the street. And so he took his $27,000 cash and he bought a sixplex somewhere in California. And he lived in one of the units, so he had a place to live. And he rented the other 5, cash flowing property right off the bat, number 1.
Amazing.
He said that 2 years later, he sold that and he made about $400,000 on the sale. He called the lady up and he said, hey, look, I got all this money now. I want to go buy a house. She said, no.
Mm-hmm.
We're going to sell that one. We're going to trade up. And they took that sixplex, they sold it, and they bought a 12plex.
Wow.
He's like, oh. A few years later, they sold a 12plex, they bought a 36plex. And he's just been on that journey ever since. And now he owns 13, 14, 15,000 units. And that's where he makes all his money.
Yeah.
Rent where you own, buy real estate,
Yes.
but cash flowing real estate.
Yes. Well, listen, Grant Cardone's got a book, The 10X Mentor.
Yeah.
And I don't know if you read it. I've read it 3 times. Well, I listened to an audiobooks and I've listened to it 3 times. And every time I listen to it, I get more motivated and more inspired by his story and how he got started in real estate. Yep. I was at the multifamily conference last year where, trying to remember his name, is with Jennifer Lopez. What's the baseball player?
Oh, yeah, from New York.
From New York Yankees. A-Rod, Alex Rodriguez.
Yeah.
Yes, I had a brain fart there for a second. Comes with age, could be 50, be 53 soon. So A-Rod was there, and I was right up front row, and people were wondering what's A-Rod, what's Alex Rodriguez doing at a real estate conference? This guy's a baseball player.
Yeah.
But he shared his story. And his story, when he started playing baseball, he was reading this book. He was on the bus going to another city to play ball, and he was reading this book that the average lifespan of a baseball player is between 5 and 7 years, and that within a few years they're all broke after. So he made a promise to himself that every year he was going to go buy property, 1 condo, 2 condos. He started getting the multifamily. And when he got his bonuses and money, he took that money and every year he bought real estate. Yeah. Do you know how many doors Alex Rodriguez Incorporated owns?
Nope.
Over 20,000 doors.
Awesome, eh?
That guy is a multi-millionaire. He puts together deals that make Grant Cardone look small because his connections. He's got billionaires. He's got a Rolodex of billionaires he could pick up and they'll go in on deals. Guy's got 20,000 doors. What's Grant got, like 12,000?
13, 14 now, yeah.
13. Yep. A-Rod's over 20,000 doors.
Yeah.
And he got it.
Yep.
Most of these guys, they take their money and they got their posse and they're buying houses and buying cars and spending on bottles and nightclubs. This guy was buying real estate.
Yep.
He's retired. The guy's a multi-millionaire. So I love what you're doing with clients and teaching them, and it's not good to own where you sleep, but mathematically it doesn't make sense.
Yeah.
But get into cash flowing real estate. So you just got back from, I saw your video and you were down with Grant Cardone, and so you just got 10X mentor. Explain that. What's a 10X mentor and how do you go through that licensing and what are you now able to do?
So I signed up this year. I've had various different coaches my whole life, whether it's in sports with my racing or whether it's in business with mortgages. I've had various different coaches from different companies over the years to help me grow. Recently, this year, I signed up to be mentored and coached by Grant and his team. So I signed up to a very high level of coaching. I have a personal coach, and I get on also calls with Grant. So they're helping me grow my business so I can help more people. And during that journey, it came to light that I think I could contribute by becoming a coach for other people. I have enough people in my sphere, other mortgage brokers, realtors, clients, etc., that I think I could positively impact. So I signed up, took the courses, and I'm becoming a licensed 10X coach myself, which means I have access to all of the Cardone Enterprises material, all of Grant's Cardone University stuff, and I am learning and growing through their coaching program so I can help more people get to where you and I are going. Because that's the goal, right? Like Jim Rohn says, you'll have everything in life if you help enough other people get what they want. And that's my mission, right? Is to just impact as many people as I can and get them out of this middle class cycle that they're stuck in. You always hear the renters say, because the government and the media pitch it this way, it's not fair that we can't get into real estate, right? The gap is too big now. Our generations coming up will never be able to own, right? Well, now you and I are educating people, get out of that mentality. You don't need to own where you sleep. Look for tools and strategies that can help you get in despite where the market is, but into cash flowing assets instead.
Yes.
And there's a lot of tools out there, this side of the border and south, where people can either buy their own investment properties or invest in other cash flowing properties, right?
Like into a syndicate.
Yeah.
Okay.
Right? So there's still ways that we can help people get into real estate without having to buy an owner-occupied liability. Start to generate that wealth in other ways, and then start to bring in 2, 3, 4 streams of income through life insurance policies, which I know is a big one. We have one with you, right? Like that's a really big one that we love to pitch to people. And then the real cash flowing real estate. And as we start to educate people and show them these other ways to view money and to view wealth, they don't need to go chasing the banks for a cheap rate on a mortgage to go buy a house that they can't afford. Right?
Yeah.
So,
you know, it's funny. I have a client, and she listened to one of my podcasts about owning. I talked about owning versus renting and how I rent. And, you know, people view me as like, man, this guy's got nice cars. He's always traveling. He's got this, he's got that. But the guy rents? Yeah. Again, do the math. After they heard my podcast, they called me up and she's like, John, we want to sell our house. I'm like, okay, you want to move into something bigger? She goes, no. We don't own, we owe no mortgage on our home. It's free and clear. But I just heard your podcast and I want you to sell my house so I could take the money and I want to go buy some multifamily units with it. And then I'm going to take that cash flow and I'm going to live rent free. I'm like, I'm glad people are paying attention. They're listening, right? Cash flow. They're going to live rent free, right? And now they're going to have these properties that it's only going to increase in value. Then they can refinance that and take the money and go to do the same thing, right? Have lots of babies with it. Right? Rinse and repeat. We're about running out of time here. I got one more question for you. If you could go back to your younger self, what financial advice would you give your younger self that you think that you would have liked to know today?
Don't spend your money on garbage. Spend all of your money investing in cash flowing assets. If I had done that 35, 40 years ago, look where we'd all be right now, right?
But you'd be 1 year old.
I'm 50 years old, buddy. I wish, but yeah, I mean, in my teenage years, if I had been told, don't squander your money, work hard, sock it away and invest it into cash flowing assets, don't go in the stock market or crap like that, put it away into better things, then That's the one thing I would say, invest wisely.
Mike, it's been great. Now, listen, how can people find you? Because I know you're doing a lot of really great things with the Manulife One product.
Yep.
How can people get a hold of you? I know you got social media. Tell my listeners how they can find you.
So my main website for mortgage brokering is momentummortgage.ca. So people can go on there. My contact information's on there. My cell phone is 705-331-6153. Call me anytime.
Amazing. Guys, I got some really great news. My book is finally going to be published in about 2 weeks. You can actually pre-order the book if you go to wealthwithoutwallstreet.org. You can actually pre-order it there. It's in about 2 weeks. It's going to be in the queue to be published. So I'm pretty excited about that. The website is now live. Thank you for listening. If you like this episode, please like it, share with your friends so we can build the algorithm. Mike, thank you so much for joining us today. It's been great having you. I know we can probably carry on for another hour or so, but I like to keep my shows under an hour, and we're about there at the time limit. That's all for today. Take care of your wealth and your health.